What up, Faith family? Returning to you with Understanding Stocks Lesson 2, presented by me, Rod Bermudez.
And Paprika Johnson. Let's not do that.
Oh, we starting early. Okay, let's get straight into the disclaimer.
This is not financial advice. This is simply Rod sharing his knowledge based on his personal experiences. Nothing in this video should be taken as fact until you do your own research. So, don't play yourself.
And I still have no clue whose mama that is, so let us continue. So today we're going to learn about dividends, short-term capital gains versus long-term capital gains, and how much does it cost you to be free.
Okay, so what's a dividend?
Well, since you asked nicely, I'll tell you. A dividend is money that a company pays out to its shareholders. These payouts can either come out monthly, quarterly, which is every 3 months, semi-annual, which is 6 months, and annual, which is every 12 months. Think of dividends as a way for companies to share a percentage of their profits with you. So here's a fun fact. Dividends are also a way companies can either gather more investors or trap them.
Wow, so they really be out here scheming?
We'll speak on that soon.
That's wild. So, where can I find a company's dividend?
All right, so first thing I recommend you do is go on seekingalpha.com. And once you get there, you're going to type in the company that you're interested in. Once you type in that company, you're going to click on dividends and then scroll to the bottom. When you get to the bottom, you'll see the most important things being the dividend yield, your annual payout, the 5-year growth rate, the amount, and the dividend frequency. So an alternative site that you can use is also yahoofinance.com. Same thing, you type in a company that you're interested in, and you'll see that there's something that says a dividend yield.
Okay, so please explain what a dividend yield is for the people in the bike.
In the bike? Where are you from? Anyway, dividend price divided by the stock price equals your dividend yield. This is simply just a fraction of the stock price that's given back to the shareholder.
Okay, I get it. And don't be slick. I talk how I talk. Don't get smart.
Boy, y'all see what I'm dealing with?
Yup, deal with it. You'll be okay.
In some states, there's gotta be abuse, but moving on. So when we're talking about dividends, it's not always so good in the hood. We gotta be aware of dividend traps. A dividend trap is when a company that performs poorly will purposely offer a higher dividend in order to bait investors to buy shares as they are losing value. Once you are invested, these companies can potentially hold your money, claim they are unable to pay, file for bankruptcy, and run off with whatever amount of money investors left them with.
Wow, that's tough.
Facts, super tough, which is why we need to pay attention to the red flags. So pretty much the first thing that I would tell you is that you want to look for announcements of dividend cuts. Second thing you want to look for is a 5% yield or higher. If that's the case, you're going to want to investigate why, and also you want to see if the company's profits are growing. You also want to pay attention to what management is saying. So if you turn on CNBC, they say something crazy like, oh, we're looking for financial flexibility, or we're cutting dividends to improve our balance sheet. This simply means that they have been irresponsible with their money.
Frank? Me think somebody made a boo-boo.
Or they just don't know what to do with their money, which is bad management. So with all of that being said, would you really trust an addict to flip your money?
Check this out, man. I got these burgers, man. They some double cheeseburgers.
Oh, hell nah.
And that, my lady, is the right answer.
So, what are some pros and cons of dividends?
Alright, so let's start with some pros. First, dividends will add more wealth to the shareholder. Also, a company that pays dividend is a good sign of a growing company if they have a healthy balance sheet. A sign of a healthy company is one that is able to consistently increase their dividend payouts. Major investors love this. This will cause investors to buy more shares to secure the larger payout. Now, some cons. If you are invested into an unstable company, you may see them decrease their dividend payout. or completely eliminated. This is a sign of an unhealthy company. There are companies out there that pay high dividends to prey on the unknowledgeable investor. These companies usually have unhealthy balance sheets. These are known as dividend traps. No matter what, keep in mind that you still have to pay taxes on dividends too.
Oh my God, taxes, taxes, taxes. What's the big deal with taxes?
All right, so let's start this off by talking about your short-term capital gains. These are gains from selling your shares and taking profit within the same year. These gains are taxed at the same rate as your ordinary income, at about 20 to 40%. And you also have your long-term capital gains. So these are gains from selling your shares that you've held over a year and a day. These gains are taxed at a lower rate at about 0 to 20%. Donald Trump. Simple as that.
I got this part. Y'all better talk with a certified public accountant to get updated on appropriate tax laws.
Whew, look at you, on point with the disclaimers.
Sensational.
Thank you, thank you. I know I'm fly. So, when can I break free from the 9 to 5 and buy me a Birkin, a Bentley, and a baby daddy?
What?
Stop it. Get some help.
Sheesh. So that's the focus, huh? Man, a great man once told me that it's funny how we equate wealth to material things.
Oh, so you saying I'm materialistic, right?
What I'm saying is, it's cool to have things, but it's cooler to have assets.
Message!
Alright, so let's break down how we can break free from our 9 to 5. So the average income per person in the U.S. is around $35,000. The average age for death in the U.S. is around 71. The formula is 71 minus your current age times your annual salary plus 4% for inflation. And that will equal your freedom number. So if you are 25, 71 minus 25 equals 46. Then you want to do 46 times the 35,000 plus the 4%. And this will equal about 1.7 million.
1.7 million. Oh, by that time, I better have...
Bro, you better not say it.
What? I was gonna say assets.
Cap.
Alright, I'm gonna let you live with that one. But getting back into it, for someone that is able to survive on $35,000 per year, 1.7 million is the magic number that would allow them to walk away from their job. This is what we need to understand, that this is the reality. It takes knowledge and consistency to produce the freedom that we want. We have to allow our money to work for us and stop trading time for money if we want to gain true wealth and freedom. So what we really need to understand is that when we make our daily purchases, we fail to realize that these transactions are actually time-based and not really money-based.
Sheesh, I'm not gonna lie. That seems like a lot. Where do I even start?
I got you. But reality is, it will always seem like a lot if you don't have a plan.
Facts. If you fail to plan, you plan to fail.
That's right. So you remember when I mentioned in our previous lesson that there are multiple asset classes to participate in that'll help you build wealth? So you can always find ways to build liquidity fast through trading other assets. But the most important thing to understand is that stocks and dividends should be the foundation that holds it all together. Plus, you can also pass it down from generation to generation. This is how we build generational wealth.
I love the idea of generational wealth. So, what's the plan?
So the plan starts with us respecting and understanding time. We must first understand the real meaning of time is money, and we must also understand that money can also buy our time back if used correctly.
So, what does time is money really mean?
So let's go ahead and simplify that. Let's say you make $15 an hour and you work 40 hours a week. And let's say your electric bill is $50 per month. So to cover your light bill, you have to work 3.3 hours. In reality, this means that your light bill costs 3.3 hours of your time, not $50. Now do this with every other expense, and also do it with what you call fun money. So you should probably take a moment and ask yourself, how much time does it cost you to have fun?
So, you trying to tell me that my Birkin costs 3,300 hours and my Bentley costs 21,000 hours?
Yo, baby daddy better not be broke.
That's crazy. How can I buy my time back?
There we go. Now we on the right track. So, ownership of assets can buy your time back. Let's say you saved up $15,000 or $20,000 and you decide to invest that money into Southern Company, which is a company that supplies electricity to most southern states. For that same $15,000, you will be able to own 220 shares of Southern Company. The dividends from those shares can now pay the light bill every month, all while you still have $15,000 growing and working for you in the bank.
So, we pretty much just have to change how we view money.
Period. You have to understand that money is simply a tool that allows us to buy assets. Our assets are tools we use to secure our time. Our time is what we use to expand our creativity, and our creativity is what we use to make money. It's simple, rinse and repeat.
I'm definitely about to buy my time back, no doubt.
Bike? Oh my God, we were doing so good. Anyway, in our next lesson, we're going to dig deeper into understanding balance sheets and breaking down if the company is good with money or bad with money. We're also going to talk about the importance of earnings reports. So until next time, keep the faith.